So there's a new mortgage loan in town. But is it really new? Or is it just new to you? So if you are anything younger than I am, and I'm not telling you what that is, you may not have ever heard of an adjustable rate mortgage. Now that's not to be confused with a variable rate mortgage. That's something for another video. But it is a loan that old people like me have heard of. In fact, my first loan in 1996 was a loan that adjusted every year for 5 years. It was a 1-5 adjustable rate mortgage. Well, it's a different kind of loan that has a low introductory interest rate, which is awesome. However, once that special introductory interest rate is expired, that rate can now adjust up and down. So basically, the banks are giving you a break on the interest rate at the beginning because you are taking on more risk that rate could go up and up and up and up. Now, it doesn't just go up willy-nilly. Each bank looks at a specific index, and it could be the U.S. Treasury bond, or it could be the London Interbank Offered Rate, or the LIBOR index. That sounds hoity-toity. And there's a few different indexes out there that banks look at, but they're going to look at one of those, and they're only going to look at one. And if that index goes up or down, your interest rate will go up or down with it. Now, these things have been in existence for a while, since 1982, as a matter of fact. In 1982, the Garnes-St. Germain Depository Institutions Act was passed by Congress that allowed banks to offer these adjustable rate mortgages in response to the incredibly high interest rates of the 1980s. In the early 80s, interest rates were like in the high teens, 16, 18%. And people pretty much knew that they couldn't stay that high forever. But who wants to lock in a 30-year mortgage at that rate? And thus, the adjustable rate mortgage was born, which allowed those people to get their mortgage at 16 or 18% and still allow those people to take advantage of the falling interest rates. And just a little reality check of what 16 or 18% looks like in a mortgage. If you were to take a $350,000 mortgage, put 20% down, so you're actually only borrowing $280,000. At 6%, the monthly payment for just the principal and interest would be $1,679. Now take that same $350,000, put your 20% down, $280,000 loan at 18%, your monthly payment is now $4,220. And that's principal and interest only. Then you'd have to put your taxes and your insurance on top of that. So they were pretty popular when they first came out. And then they kind of waxed and waned through the next 20 years after that until right before the 2006 housing crash. If you remember back then, there was a lot of, let's just say loose lending standards going on. Kind of the Wild West of the modern lending era. And adjustable rate mortgages hit an all-time high in 2005 of 34% of all mortgages originated. Until post-2008, when all the new lending restrictions were put onto the banks and lending got way, way tighter. At that point, ARMs were down to under 10% of all mortgages originated, and it stayed that way for about the next 10 years. Housing demand was going down. Interest rates were going down. Home prices were going down. Fewer banks were even offering it as an option. Media pundits and financial advisors were putting huge emphasis on a 30-year mortgage. And people in general just wanted more predictability. They didn't want a changing monthly mortgage payment. Eventually, rates got so low that why would you ever take unpredictability at 3%? When you could have stability at 3.5% to 4%. Just wasn't worth the risk. And that brings us all the way to 2022. Now, at the beginning of this year, they were still down at like 5% of all mortgages originated. But in the last couple months alone, with the big interest rate hikes that we've had, that number is jumped up to 11%. And with that interest rate going up and up and up, you are more likely to hear them talked about much more frequently in the future. But buyer beware. Depending on how this loan is structured, there certainly are risks for you, the borrower. And I don't want to see anything like that trip you up. So go to this video right here that goes into much deeper detail about what they are, how they work, and if they're the right choice for you. Thanks for watching. See you next time.